Okay, the recording just started. So good afternoon, everyone. We're just going to take a minute. We see people just joining in and we will start. So we're doing this after a break of a week, but I see some welcome to all our regulars. I see you. Thank you for joining. Okay, great. Childs, we'll get started. Okay, I think people are still just coming in, but I think we'll start. We'll do a sort of ease into our intro, and by the time we'll have everyone who's sort of coming in. So actually, the way I see it, and again, warm welcome to all of you. The way I see it, this today's session was more about an alternative to and understand all the alternatives that are there to direct equity investing, but clearly looks like people, like direct equity investing. And that's how I look at it with the number of people who, actually joined. So, but all of you who are here, that's amazing. You obviously want to learn, and also you have a diversified portfolio in the true sense. So, so we will talk to you more about that. But just before we, get started, I'd just like to tell you a little bit because I see a couple of new people, like just in terms of who we are. So we are an AI fintech, company based out, actually headquartered out of UK, London. But India is a very strategic and big market for us. And the Investor AI app uh, is the app that we have, which uses AI and gives you insights on what stocks to invest in. So you have a whole lot of uh, places on how you can invest, but there's nobody really telling you on what you can invest in. And actually, that's what we do, Investor AI. So look us up. And today's session, we will not be covering Investor AI in detail, but if just here and there, I think we'll just give you examples of possibly where or what it could do, because the topic's extremely different. So I think we'll just jump straight into that. I'm going to start with a poll, but before that, I'd like to introduce Shailesh Sridhar, our go-to person and leader for everything that's to do with that Investor AI app and the equities, that you see there and the insights. So thank you, Shailesh, for being here again. He's very popular with the webinars, and people actually write into us and tell us when is Shailesh doing the next one. So here he is, and on a very, very different topic. So we'll move to Shailesh shortly. But just before that, Prabal, can we just get one of the poll questions up, because it will actually help us, know how many of you, have been investing for how long. So please go ahead and answer this poll question. Okay. Okay. Wow. Okay. Over 50% are in 3 years plus. So you guys are big investors or know the investment market very well. The 0 to 3 years, it's again the rest of the there's about 45% there. So that's great. Thank you for that. That will actually help us. One more question for you. Perhaps can we have one more question? This is an interesting one because this will also tell us how well you've been in the stock markets or you've been in the investing world, but how many of you have actually, what your experience really is? And okay, it's interesting. We see more often than not people actually saying that they have made money, but of course we still have a couple of people who lost a little. So cool. This actually helps us, and I think Shailesh, if this is really uh, some food for thought for you to in terms of how you would like to cover your session, and maybe even give them some tips on how they could do insights and make more money. So over to you, Shailesh.
Yep. Good afternoon, everyone. I'll just share my screen. Hope my screen is visible.
Yes, it is, Shailesh.
Yeah. So before I get into the various instruments and asset classes that are there other than direct equity, I want to speak about why should we even get into other instruments. Right? Now, as we all know, equity markets have some sort of a cycle. So when things are going well, you'll always make a lot of money. Since stocks are going up, but there will also be down cycles, bull cycles, bear cycles, like any place everywhere, right? So over a period of time, you would ideally like to diversify your investments. What do I mean? So when you're younger, you would have more capacity to take risks. So you will ideally have a more allocation to equity markets. And across time, you would actually move it as you grow older and older, because money is more important to you. Money is more you need it for your healthcare bills or medical bills, just or even to survive sometimes. So you would need you can't take risk anymore. So that times you would have to put more in, like maybe fixed deposits, right? That's the India's biggest investment, easily India's biggest investment, most retail investors favorite investment. So it is important to know what all possibilities are there, so that as you grow, as you plan your financial portfolios, you can give due consideration to them. So as part of today's webinars, I would be covering a little bit. I just cover the how the things work in mutual funds, ETFs. And I'll speak about a couple of special instruments, and then there is futures and options, which I had touched in my last Get Set Go this thing, and I'll take a little bit more deeper this time and explain with an example how things work. So let me just get into mutual funds. Now, what is a mutual fund? It's just an asset management company who's actually pooling investors' money and then putting it into direct equity investments. You don't have to put it. The asset management company will do it. Now, why do you do it? Now, for example, the best way to get rid of risk is, for example, if you're an equity investor, right, you put only in one security or two securities, there would always be risk of something very specific happening just to that company or that particular sector. So if you invest in a diversified mutual fund, your risk would be lower. What do I mean by risk? Especially when market crashes or bad things happen, your losses would be on the lower side. So for you to lower risk means lower possible losses in the future. Okay. Now, what sort of mutual funds exist? There's something called open-ended and there's close-ended. Open-ended means you take the mutual fund every day. The opposite side of your transaction, whether you're buying or selling, is the asset management company itself. So every day, these funds you can either buy or sell. I mean, sell only if you have bought it before. And then you can every day there is, at the end of the day, they publish something called NAV, net asset value. It's essentially the value of the mutual fund unit that is allotted to you, and based on that, your profit or gains or losses would happen. Now, the close-ended fund, you normally buy it during the NFO, which is called a new fund offer. That's like an IPO for a mutual fund itself. And only at the end of the maturity period is those funds redeemed at once by the asset management company itself. Okay, now let me speak about what different sort of asset classes are there. But before that, about 90% or 95% of the people invest in open-ended mutual funds. I have invested in both. I use closed-ended mutual funds to invest in debt funds, and I'll speak about that later. Next is asset classes. So you can either invest in equity or debt. Debt is essentially maybe the mutual fund is buying government securities, or it is buying even liquid funds. Liquid funds is so something like treasury rates, and also they are buying corporate bonds. So you may be getting interest anywhere. The underlying of the mutual funds may be getting anywhere interest from about 3% to all the way up to 9%. Then there's hybrid funds, which who would invest in combination of equity and debt. And then there is, of course, gold funds who would basically take the money and invest in gold. The next biggest thing I want to speak about is something called direct versus regular funds. Now, each fund will have a direct and regular fund. Now, what does that mean? Regular funds means you would actually buy it from a distributor. And direct funds is you almost buying it directly from the AMC. Although intermediaries are involved, you're not paying them extra money. Now, why is this important to know? Every mutual fund they have to do buyers, sellers, they have their entire asset management company, they have to pay everyone's salaries. There's something, they have some expenses overhead for the fund manager, their salary. So they charge something called an expense ratio. Now, what does that mean? You start with an NFO of 1,000 crores. You invest in 20 securities. It goes up 20% at the end of the year. So your assets is now 1,200 crore. However, for about, you may have to pay all the fees, salaries, audit fees, everything. So that would be maybe about 12 crore. So that's essentially 1%. So that 1% is actually reduced. And for you, the value is just 1,188 crore. So for you, expense ratio will actually take away, like it will kill the part of your profits. Now, the worst thing is, even if the losses happen, obviously, even those asset management companies, their salaries have to be paid, right? So the expense ratio will still be deducted. So it will always be, you will lose it. You may not see it from the NAV, but in the back end of the NAV computation that you are getting, the expense ratio always there. So when you're picking funds, you try to pick funds which are lower expense ratio. So that, and big funds will have lower expense ratios as well. The thing, why did I bring that up? Regular funds will always have a higher expense ratio by about 50 to 60 bips. That is essentially 0.5% to 0.6, 0.8, sometimes even up to 1%. So the mutual fund itself would take about 0.5, 0.7%, and then another 1% would go to the distributor. So even before you start, if the market goes up 20%, you're already paying 1% to the distributor and 0.7% to the asset management company. So just be aware of that while picking funds as well. Try to, of course, I mean, if you need advice, there are different possibilities of how you can go through direct and regular. But if you're doing it on your own, like without any advice, it is always better to go with direct, because for the same investment, you will make 0.5, 0.6% more money, regardless of what happens. Okay. Next is about exit load. So if you ever sell the units, sell your mutual funds less than a year, or sometimes it's even smaller, 1 month, there is a 1% cut that the AMC will charge you. So look at the exit load before selling. Okay. Now, why would you invest in a mutual fund, right? The biggest thing is it doesn't need a demat account. So you can just use your PAN, link your bank account, and there's so many apps, and even the asset management companies itself have where you can just go to their website and start investing almost in like 2 or 3 minutes as soon as you're done with KYC. So you don't need a demat account. Anyone can invest in that. So that's number one. The second one, there's something called an SIP or a lump sum. Now, lump sum is where you have 1 lakh rupees and I'll just put it. Now, in SIP, you would have a monthly income. So you say, okay, every month I'll put 10,000 rupees into a mutual fund. Now, why is SIP good in certain ways is that it inculcates that mentality that, hey, I need to plan for a future. Maybe it's a house, maybe it's marriage of children or education of children. So let me start saving right now. And because the money will keep getting deducted from your account every month or every week, depending on how you set up the SIP, you will always invest it, or else there would be many people like, as soon as money comes to my account, okay, let's just party with it. So this actually helps you save that habit. The only problem with it's not a problem, but when you compare it with other instruments, it's a problem. It's just you can't trade it real time. Now, what do I mean by that? You think at 12 o'clock or 10 o'clock the market is crashing, right? You can't sell it immediately, though you can put a sell order. The sell actually happens only on the end of the day NAV. So it's not, you can't trade it in real time. Okay. Now, of course, a mutual fund is a long-term investment, so you don't need to be a trader to get into it, but it's just a thing on that. So let me just now move on to ETFs. ETFs are, as names suggest, exchange traded funds. This is also very similar like mutual funds. The same, you pull the money from investors and put it. Only difference is most of the time, these are exchange traded. So they are literally like stocks. You can literally buy and sell throughout the day. So you are actually, the other side of your transaction is actually another investor. So you would, and most of the ETFs in India right now, which is a just growing market, are index funds. Now, what is an index fund? So they track a very specific index, and the performance of the ETF will try to replicate the index 99.5%. So if the Nifty, if there is an ETF called the Nifty ETF, if the ETF goes up, if the Nifty underlying index goes up by 20%, this will go up at least 19.8, 19.9%. So it's that close the ETFs would be. And most of them are index funds. Okay, I shouldn't have written open and close in it. So let me move on to intraday trading. So you can intraday trade. So you can buy and sell like stocks at any point of time. The only expenses that you are hit is the brokerage charges when you buy or sell an ETF. However, nowadays it's all long-term. Delivery shares are almost no brokerage, as you could have see if you have seen my earlier webinars. I would have covered brokerage in detail. So essentially, it's very, very less brokerage. Now, even mutual funds, there is if you do not exit within 1 year, there is no fees for you to transact itself. Of course, they charge exit load and expense ratio, but per transaction, there is not really a brokerage associated. So mutual funds are like sort of free to get in. So your first step, whenever an investor tries, they always get into mutual funds. Okay, now let me speak about top ETFs in India. The top ETFs are the main one, Nifty index. So whenever someone wants to index in a Nifty fund and they think that mutual funds managers may or may not beat, because mutual fund managers will try to play with the weights. For example, they would have their own personal view a little bit. They think Reliance may do better or Infosys may do better. So they would have more weightage for certain securities. And that's how the performance itself can be different. So the index might go up 20%. A large cap mutual fund may go up 30% or even 10%. It could vary so much. So you have Nifty ETF, which is the most traded one. There's something called liquid Bs, which is like your liquid fund. It gives you about 3.5% interest. It almost grows as if it's 3.5%. Then there is gold ETF. Now, gold ETF is essentially you can just invest the money, you can buy the ETF, and the ETF price will move like how the gold price is moving. So instead of buying gold physically, directly going into a shop, buying a 10-gram coin and paying GST and all sort of taxes, you can directly buy. First, you can buy a mutual fund. The even more cheaper option is buying an ETF, where the expense ratio would be even lower. So as I said, the cheapest way to invest, most ETFs are even cheaper than mutual funds. And you can invest or exit during market hours. Only problem is there are not many options. In India, there's about 600 mutual funds with different schemes across 40 asset management companies. But if you really take ETFs, there's only about 50. And if you even remove the ones which are illiquid, there's just about 5 or 6 we can trade. Now, what do I mean by illiquid? The difference between the buy price and the sell price itself is 0.5%. So you will actually might lose a lot of possible gains even before you're trading, right? The final one I want to speak about is debt ETF. There is an ongoing issue going on, and there is a lot of issues that are coming in debt. So what happens is this ETF invests money in not just government securities or corporate securities, and they pass on the income stream. And essentially, these have a close date. Now, what do I mean? You can, if you buy it today, on the expiry of the debt ETF, you would actually know how much percent interest ish you will get. But if you ever invest in a debt mutual fund, you can't really be sure of how much money you make unless it is a close-ended fixed maturity plan. So it is important to understand debt ETFs because nowadays it's being massively sold. There is a lot of money being put in. Half of my portfolio is in debt ETF. I could tell you that because one of the issues nowadays, there's a 10-year ETF where you get 6.8% if you hold it till maturity, and after tax is just 6.1%. So 6.1% after tax is a big number because nowadays, if your other basic choice is to put money in a fixed deposit, right? SBI, HDFC will pay you just 5.5%. And if you're in a slab at 30%, on 5.5 lakh, on 5.5%, you're paying 30% tax. So your after tax is just 4.2, 4.1%. So it's really, it's so low. I mean, it's not even better than the inflation rate, right? So you will actually be losing money anyway. So you would rather put it in more and more instruments and actually earn better interest. Of course, there is always more risk. But I mean, to quote a movie, risk hai to ishq hai. Let me now move on to other specialized.
We had one question because you're on that topic, and you're talking about ETF. If it's sector specific, is it riskier? That was the question.
The sector specific ETFs actually invest in the index itself. So it would be literally, for example, I think the famous one is bank ETF. That's the most traded one. And anyway, most people know bank Nifty as well. So it just replicates the index. The problem with bank Nifty is the most of the weight is just 4 securities: HDFC, Axis, Kotak, and ICICI, and SBI as well, 5. So 85% of the entire ETF weight is just 5 securities. So you have to see, when you're seeing a sector specific, what sort of securities constitute it. So you have to see if the sector, it's diversified enough. But yes, to answer your question, a sector specific ETF is always more riskier than a more diversified index level because it's very sector specific. So a tech ETF, right? It would invest in Infosys, TCS, Wipro. So if TCS is doing bad, maybe Infosys and Wipro will do well. However, if the entire IT sector is under pressure, then your entire sector would go down. So it's not really diversified. It's always a little more riskier. Okay. Let me move on to other specialized instruments. I'll speak about, these are all very, very new instruments. They are just started over the last 3-4 years. And a lot of investors are going into it because your normal fixed deposit rate is 5.5%. And after that, you have to pay tax, which is just 4.1%. So people are going after different sort of instruments. And I just wanted to bring it to everyone's notice. The first one is something called a real estate investment trust, famously called as REIT. Now, in US, Europe, and all, you'll find hundreds of REITs. In India, there's just 3 at the moment which are listed. So what happens? This is again a fund that collects public money and invests in commercial real estate. And what is commercial real estate? Shopping mall, or maybe something like IT park. So for example, the biggest one I said is Embassy. And in Bangalore, a lot of tech parks is either Prestige or Embassy tech parks, right? So what is the deal with how does an REIT work? It takes the money and it basically buys the underlying commercial real estate, and whatever rent or lease that happens from that is passed on as income to investors. So it's like buying a small part of a office, so that you get rent. So you don't really have to put 50 lakhs or 70 lakhs just to buy a home to get rental income. You can actually do it by buying commercial real estate as well. Now, of course, there is risk. Real estate, due to the COVID, a lot of people stopped going to offices, and office yields had come down, rent had come down. But of course, once it picks up, these securities also should start giving better returns. So these securities historically have given about 5.5 to 7% as interest. So as you can see, it's already on the higher end of fixed deposit, right? Next, I want to speak about is infrastructure investment trust, called as InvIT. Again, same, very similar to REIT. It's a trust. It has money, borrows from people, and puts now in infrastructure assets. What is it like? Grids, electrical grids, highways. And in my understanding, over the next 2 or 3 years, my understanding of the government's budget and how highways are being constructed, you will have a lot of invitees coming into the market. So essentially, if you buy an invitee, what does that mean? The company would have already built a highway. You will get the toll collected. The company would aggregate the toll and pay you back 90% of it as dividend. Okay, it's like investing in a highway. It's like owning a part of the highway. Again, now the interest, as you can see, the yield is even higher, 8 to 12%. There are three famous ones: Integrate, Power Grid, and IRB. IRB is 12% yield. However, a higher yield is always high risky. Whenever someone is offering more debt, that essentially means it's more riskier. So there may be some problems, or they may have loans which may not be, they may be able to repay. But regardless, there is an opportunity, is what I wanted to speak about. The final one I want to speak about is a sovereign gold bond. Now, what happens in sovereign gold bond? Sovereign is always, the word represents the country, the government of the country. So RBI issues bonds, gold bonds. So they fix a price, for example, 4,800 rupees per gram, and you can invest money in it. And for 8 years later, they will, whatever gold price is there, they will give you back. So it's like investing in gold. So I said about physical, then there's mutual funds, then there is ETFs. The even more cheaper option of investing in gold is actually buying sovereign gold bond funds. Now, what does that happen? Since it is government backed, you can be very clear. I mean, it's RBI, right? So it's not going to go bankrupt. They could always spend more money. The 8 years, after 8 years of holding, if you sell, there is no tax on the profit. So if gold goes up from 5,000 per gram into 7,000 per gram in 8 years, you don't have to pay any tax on it. Moreover, there's a 2.5% interest that the government will pay you. So about half of it, 1.25% every 6 months will come to you. So if you compare it with either an ETF or a mutual fund, you are paying expense ratio, and then there is no tax exemption at the end. So you would always, unless you have held it for a long-term capital asset. So this is the cheapest way to invest in if you want exposure to gold. Now, gold has always been a contra asset to equity. What do I mean? Whenever equity markets are collapsing, people will normally pull out money and start investing in gold. So, for example, last 1 year, gold hasn't gone anywhere, and the stock markets have gone up 60%, 50%. But gold, when markets were collapsing, gold will start going up. So investing in gold is a very important part of your portfolio. And India, anyhow, most people actually have an investment in gold, because whenever there's marriages, there's functions, people buy so much jewelry, there's always an investment in gold. So here you can do it even more cleaner way, without making charges, without other things. Finally, the last topic, I'll speak about futures and options. Futures, it's an obligation to sell or buy an asset later at an agreed upon price. Now, what is this different from? So the other way is to like buy a cash asset, like direct equity, right? So futures, where you don't actually buy the shares, you buy a contract whose underlying is the shares. So based on the share value, the futures value will also change. Same thing about options and calls, puts and calls, which is the two main options that are available in the listed segment. It's again a derivative, a security whose value or price is based on the underlying. Now, of course, this just seems so much theory, right? So let me take a practical example. All these are closing prices as of yesterday. So let me speak about Reliance December future and Reliance options. Okay. Now Reliance, the first one pick on the right side is the stock price closing as of Friday end. It closed at 2408. Okay, 2408. Now Reliance December future is basically the future that is traded, right? It closed at 2424. So it's about 16 rupees higher. Okay. Now, the most important point I want to bring about on futures and options is this a concept called expiry. So if you look at expiry in the box, it says 2021 12/30. So on 30th December, this contract will expire. So what happens? All the futures and options have an expiry date, and on that expiry date, they will settle the contract. Gains or loss, you will have to gain. Obviously, you will take the money. Losses, you will have to pay up the money. Okay. Now there's also something called a call option. Reliance December 2500. Now 2500 is something you call it as a strike price. So that is the level you're thinking the stock will close above on the expiry. Now why I said expiry again, to reiterate, on the expiry date, basically your hisab is settled. So based on whether the contract is in profit or loss, it's covered. So you are betting, if you ever buy a call option of Reliance December at 2500, you're expecting that on 30th December Reliance will be above 2500. Okay, so you will actually make money when the stock goes up above 2500. The call option will also go up and you will make money in the call option. Now let me speak about the put option. So whenever you're bullish on a stock, you can buy a call option, and when the stock goes up, you can make money. Whenever you are bearish on the stock, you can buy a put option. Okay, so here Reliance December 2300 put. So what happens if the stock goes down below 2300? You will make money. So that instrument will give you money. It will generate value. The value of 27 rupees will be higher, and you will make money. Now, why do we have four things here? And someone would ask, hey, I can just buy Reliance security. Why do I need to know about futures and options, right? Before I go there, actually, there's one more thing I want to speak about. There's something called a lot size or a tick size. If you ever buy Reliance in India, you can buy shares in multiples of one. So you can buy 1 share, 2 share, 3 share. You cannot buy 1.5 shares. You can do it in the US and some other countries, but not in India. However, futures and options come with lot sizes. So Reliance lot size is 250. So you have to buy minimum 250 shares at once. You can't buy lesser than that if you're doing futures and options. Okay. So let me speak about cash, futures, call option, and this. So I put in the per share values and the shares. And now I'm speaking about capital required. So that's essentially how much money you need to have in your account, your trading capital, to take position in that. For cash, you need 250 into 2400. That's about 6 lakh rupees. So unless you have 6 lakh rupees, you cannot buy 250 shares of Reliance. For futures, because it's not you're actually buying it and you're just giving a margin, with just 1,36,000 rupees, you can buy 250 shares worth futures. Okay. Now with calls, it's even lower. The call price is just 41. So you just need to pay about 10,000 rupees to buy the call option. And put option is just 7,000. Okay. Now let's assume 25 days pass and on expiry, it is at 2,600. Okay. The stock Reliance actually went up and closed at 2,600. Now, if you had bought it as a cash investment, as a direct equity investment, you would have made 48,000 rupees as profit. Okay. Now, if you had made futures investment, you would have made 44,000 rupees. Now, someone might argue, hey, I'm making 4,000 rupees less. How is futures more beneficial? However, if you see, you're investing just 1,36,000 as margin. So with just that small capital, stock going up just to 2,600, you're making almost 30% profit on investment. However, the stock has gone up just 7%. So that's how futures will amplify your profit. Okay. Now, if you look at the side by side expiry at 2200, the cash as you would have lost 52,000, but here you would have lost 56,000. So that essentially means almost 30% of your capital you have just lost. So futures is like borrowing money and trading on it. Obviously, unless you are completely aware of how risks work, you shouldn't get into it. But once you know, it actually helps trade, and most professional traders get into futures and options because you can use your capital in a much more bigger way, right? Now, let me speak about call and put options. If you see at 2600, the 2500 call would be worth 14,750. Would be make you a profit of 14,750. So just by putting 10,000, you made it 14,000. So 130% returns in just 30 days, just because the stock went up 6%. That's how amplified your options profits can get. Okay. Again, however, if you had bought the put and the stock didn't go up, you would lose the entire money. The 7,000 you put, all that 7,000 is gone. So that's how call and put options work. Call options, obviously, you're betting on the stock to go up, and put options, you're betting on the stock to go down. I would stop it from here because I think we are running out of time. Please do chat away your questions. We would be more than happy to take it up.
So we do have questions. I'm just going to start with I'm going to start with a very valid question from Azhar Khan. He actually asks, in our app, ETF for India is not available.
Yeah, so we are working on it. We think it would be available over the next 2 months. The problem with the way our ETF module is structured is it enables you to create portfolios of multiple ETFs. Now in US, there's about 1,700 ETFs. Okay. And in UK, there's about 400 or 500. In India, there's just 50. And the ones that are really getting traded are just 4 or 5. So what happens? It isn't completely done yet. So there's only 1 or 2 ETFs that you can actually buy and sell. So yeah, but we are still working on it, and we should get to you pretty soon.
Okay, and we will of course let you know once it's there as well. You will hear from us. So we have a question when you were actually talking, from Adhavan. He actually asks, could you once again explain about exit load and also about a specific point you mentioned on regular versus direct?
Yes. Exit load essentially means it's like a penalty that the asset management company is charging you for selling the units very quickly. Now, depending on the mutual fund, there might be a higher penalty for 1 month. So, for example, if you buy today, if you sell within the next 1 month, you will pay a 1% or a 2% penalty. Most of the funds have a exit load at 1% at 1 year. So if you have invested 1 lakh rupees, today the worth is 1.2 lakh, but it's just like 6 months into it. If you sell, you will not get 1,20,000. You will only get 1,18,800. So that 1,200 rupees exit load is done. However, as soon as that period is over, there is no exit load beyond a year. Most of the funds don't. Some mutual funds do charge for 2 years and all. So you don't have to pay the exit load. On direct versus regular, as I said, the expense ratio of regular funds would be higher by about 0.5 to 0.7%. So that much percent per year you would be paying, means your NAV would be lower. That's actually a loss for you. And your distributor would be making money from it. So from direct, you would, if the same scheme, if you buy the direct version of it, you will actually make better returns. So it is the same return. So for example, let me speak about some blue chip fund, some large cap fund. 15% returns from the, so same money is invested in, 15% returns have come. For direct fund, it would only be 0.8% or 1% that's gone. And for the regular fund, that would be 1.6%. They will deduct that and then you will make the money. So you will just lose more money by investing in regular.
Okay. So staying on the sell question, Samantha, who's one of our subscribers as well, asks, is our ETF investments more difficult to sell? She just wants your views.
Absolutely. As I said, right, out of the 60 ETFs, apart from the top 2 or 3 or 4, right, I think the fourth biggest ETF has a turnover of just 9 crores. So the amount of traded every day is 10 crores. What happens, it's not difficult to sell. It's just when you try to sell, you will have to sell it for a lower price. And that's what is called illiquidity. For example, the price is at 1,000. But what happens, the buyers would be at 995 and the sellers would be at 1,005. So if you're selling, you can't sell for 1,000, you'll have to sell for 995. So there only you're losing 0.5%. So that is the problem when you go for lower ETFs. The ones with ETFs with high volume, there is not a problem to sell. You can buy and sell at any point of time. And regardless, you can sell the other one also. You'll just have to sell it for lower than it's worth. So at any point of time you can sell. It will just be like equity securities, like DMAT. It would come and sit, and you can see the ETFs as well.
Okay. Actually, Ullas and Samantha again, they've actually asked for a separate webinar on alpaca.
Okay.
So yes, we will, point noted and good one. And for everyone who's here, just a quick one. Alpaca is, a US trading platform that we've tied up with, where you can actually buy fractional shares of any stock in the US, but you can also do it directly from our app. So anyway, we will, we will do a session on that. So today, any of you here now want to think of investing in the US, it is actually pretty simple to do that. And if you ever thought you wanted to own a Google or a Facebook or an Apple or a Tesla share, you could even do fractional shares of those. So we will of course do a separate webinar on that. Shailesh, coming back to the questions. Actually, Vinay Chandavar says that he just installed our app, and but he still wants to understand the working of the same, and are there any YouTube links? So Vinay, yes, there are. If you go to our YouTube channel, Investor AI, we've possibly done over 35, 36 webinars, and we've walked people through the app itself, and also there is a video purely based on how the app works. Prabal from our marketing team will also reach out to you and share those links with you. So that's on that one. Shailesh, I saw just one more. Yeah, so Shailesh, I don't think we can answer in detail, but we have a question again from Adhavan who says, how does the AI actually work in your app? And can we see some background analysis sample? So take that question, but other one, yes. I mean, it's more proprietary, and we would, we'll explain it. But Shailesh, yeah. But there's only that much.
So what happens? We track about 5,000 securities in the world, about 650 every day. So what in India? So what happens is, from our data provider, we get data of all these 650. So for example, if it's Reliance Infosys TCS, we get their P ratios, forward earnings, balance sheet numbers, stock price movements, volumes, and using that, we create something called features. Now, what does features mean? Technical indicators, fundamental indicators, if the stock cheap, is the stock expensive, and we create all these features, and we run a ML algorithm or a machine learning algorithm. So what does that mean? It almost acts like an equation. To oversimplify it, assume a stock has only 3 features: P ratio and price to book. So it would have, from that historical data, the algorithm would run and understand how much P ratio and how much price to book is optimal for a security to do well. Okay. So based on that, we train algorithm which says, hey, 2 months ago this stock had this ratio and that stock had that ratio and they did well. So like that, we train so much years of data and we arrive at that equation, and that equation would actually, based on today's values, pick the stocks that are that have the same, that show the same patterns and can go up from today. So, but it's not too, as I said, I've oversimplified it. We actually build about 900 features, and each of the model has about 200, 300 features in it. And based on it, it's a very complicated prediction on which stock would go up based on historical patterns.
Okay, great. Shailesh, thank you for that. We actually have an interesting one for the very first time. So KK, thank you for that. KK says, can we have a physical meetup in Delhi? We would love that. I just hope things get better and, we're all able to travel. We'd love to do these sessions in person and also explain investor AI in person. But for now, you can just meet us when we do our webinars, and we'd be happy to, answer all your queries. Shailesh, we don't have.
Yeah. I'll just take up, Shruti, a question from Ulas, which says sometimes idea has generated date in next day. The date that has mentioned in the app would always be the previous date. So for example, if you ever see an insight, an Alpha 330 insight or a value investing insight, it actually tells you the previous day's close. So the insights that are generated on Tuesday will have Monday's closing date. Okay, so it is never the next date. The app is updated with new insights before 9 a.m. every day. So that does not happen. The next, I had a question from Azhar Khan. How to use AI for intraday trading? There should be some scanner. Absolutely right. There are two things you can look at. One is the swing trading, swing trades section, where we provide very short-term ideas for long and short. Now there is something called technicals and fundamentals. There are two separate models, and every day morning for 5,000 securities in the globe, we run scanners. There's predefined scanners, and you can look at them. And for example, RSI oversold or MACD breakout, or stocks with low P ratio in their sector. So we run all these scanners available, and you can look at them for your trading and investment purposes as well.
Yeah, and I think Ullas also had the same. How do we get intraday ideas? So I think you've got that. And other one, you will get a lot of that information about having confidence in AI. It is very new, but we are seeing a lot of interest, and our subscribers have stayed on, and obviously these insights seem to be working for them. So try us, and you will get an idea. So so Rakesh, I think, has just come in with the last question, but can we also do option trading? And that possibly the last one, Shailesh.
You can. Are you referring to? You can in your broker account. However, through Investor AI, we have a link with SmallCase. So essentially, you can just click on the trade button of any insight, and you can actually log in through your broker and place orders inside Investor AI itself. So if you see an insight on Reliance, you want to buy Reliance, you can just do the trade, log in, and you can place the orders from there. However, we do not have direct options trading at the moment, so you cannot buy options through Investor AI.
Okay, Jayesh, we have noted your question. We've run out of time, but Prabal will get in touch with you. It could be something with the app, and we will work with you on how to get these, in the right way. Prabal, can you just get the last question up? So everyone, we will keep in touch with you. We just wanted to know what you thought about this webinar, and we will do more sessions like this for you. Right now, the big announcement is Investor AI is absolutely free. So you can actually try us, use us. This is not even a free trial period. We are talking about the app being completely free for everyone. Your insights will just come 2 days or 3 days late. And of course, if you want it immediately as and when it's generated, that's the only time you actually need to pay the subscription. So you can, experience the full power of the app. So do download and do check it out and do reach out to us. And so thank you. Thank you for responding on the poll. And, over 60% actually think it was an excellent session. So thank you so much. Shailesh, as usual, you've rocked it. So thank you so much. We will come back with more sessions like this where we can all learn. So thank you and see you soon, and download Investor AI. Thanks. Bye-bye.
Thank you, everyone. Have a nice weekend.
Bye.
Bye.